Good day, ladies and gents, fellow traders. We're here to talk about last week's movements on gold, where it moved and why it moved. We'll start our discussion on a fundamental note. But before I go any further, just to make it clear, most important trading rule, plan your trade and trade your plan. Absolutely ever. And never forget the number 2 reasons, the most important reasons that the markets move up and down. And that is actually supply and demand imbalance. And of course, the level of novelty of your retail trader, like yourself, like myself, and many, many others out there. Because in the end of the day, without rising and decreasing levels of novelty, we would not have supply and demand in balance. But what is supply and demand, which is actually many, many times confused with support and resistance. But to make it clear, support and resistance helps you predetermine turning points into the market, as much as eating ice cream 3 times a day helps you to lose weight. Supply and demand is actually an economical model. We can study it in macroeconomics. It's an economical model of price determination. It stands behind one idea, and one idea only, is that in a competitive market, such as the foreign exchange, stock market, or whatever else, in a competitive market, the unit price of a certain good will vary until it settles to a price and moment in time where quantity demanded by consumers equals the quantity supplied by producers. And that, economically speaking, gives us an economical balance in price and quantity. Now, of course, many, many times we have more demand than supply, more supply than demand, or more demand and supply remains unchanged, or vice versa. We have 4 different rules of supply and demand levels, which are extremely, extremely important when you trade supply and demand. I will get into that in probably in other videos in the future. But the most important thing is to understand that when we do have imbalances in supply and demand, a shortage or a surplus occurs of that particular asset. And of course, combined with the most important fundamental factor, or collage of fundamental factors that took us in that particular moment in time, not forgetting the fact that banks sell to retail traders and buy from retail traders, and not forgetting the fact that supply and demand is an institutional trading type of strategy, and most banks and institutions actually trade supply and demand. And obviously we would be able to be looking at the markets from a totally different perspective. Fundamentals are also extremely important when we're looking at that. That's why let's go actually a little bit into the fundamental events of last week. What happened and why? What were the price drivers of the US dollar index and gold? Of course, we could mention the FOMC meeting minutes with a slightly hawkish tone to it. Fair enough. We can mention the Jackson Hole symposium, where amongst many others, our dearest Chairman Janet Yellen discussed and of course expressed her opinion regarding today's markets and where we stand and why. And with no surprise for myself, and I'm sure many of you guys, the conclusion was that the interest rates may be raised sooner, much sooner than initially expected. Fundamentally speaking, what would that give to your, how would that affect your market? Of course, you would increase demand in the US dollars by foreign investors, obviously, yeah. And of course, you would help the US dollar rally as it did, equities rally as they did. But the most important thing for you and me, and the thing that actually covers today's subject, is gold. It has put a lot of downside pressure on gold, and that raises pretty high concerns, because technically speaking, just to step away from the fundamentals for 1 second, if you're looking at a chart for the past couple of weeks, you would be looking at a bull when it comes to gold, or a bearish gold, as I mentioned 2 weeks ago in my video. I hope everybody banked on that. We're looking at 1300s, dropped to 1275, 72-ish, which is obviously already did, and then pretty much take a spike from there, which gold actually is trying to do today. But that's extremely important to pretty much look at, simply because if I have these kind of fundamental reports and fundamental factors, it does raise concerns regarding our position to stay bull on gold. But let's just continue with the fundamentals. A couple of interesting news that came out of the weekend as well. The Islamist group, commonly referred to as the ISIS, they created a quasi-nation state of a humongous size. Yeah, it stretches across huge parts of Iraq, Syria. The interesting piece of info over the weekend, They apparently captured a Syrian airbase, and they have stated plans to capture not only Baghdad, but the entire countries of Spain and Italy. I repeat that, the entire countries of Spain and Italy. Now, the ISIS leader, al-Baghdadi, has a doctorate degree. I would definitely not underestimate the guy. I'm sure that he has a pretty strong opinion regarding the things he's doing and why. But again, that is on the back of our heads, and it shall remain there until we will obviously have a confirmation regarding gold towards the up or downside. Again, we can be looking as well at the year that we live in. What kind of a year do we live in? Actually, a year of transition, you know, from deflation to inflation as this gold price driver, this world economical supercalifragilistic crisis that everybody was raving about, actually pretty much took a back seat, and we're looking at a much more stronger growth stance that has taken its place. But if you sit back and you look at manufacturing productions, GDPs, and whatever else consumer confidence is, you would be probably safe to assume that it creates this humongous strong growth stance. It creates more inflation than GDP. Personal opinion. Look at consumer confidence in the US at the record high last 90, now 92.4 if I'm not mistaken. Look at the Fed Philly Manufacturing Index at 28. Look at the PMI, the latest PMI US manufacturing reports, which are incredible. They're acting like a hungry pit bull, and it's extremely likely that it may take only a few of these reports more to actually make high-quality institutional money managers to ring their inflation alarms. Very important piece of information. Follow those PMI reports. It may be just a few until these inflation alarms may be sounded just like that. Let's not underestimate India. Let's not underestimate India. Let's talk about India, and let's not forget the fact that India, in the end of the day, has the most important price driver for gold. And don't mind me saying, but the data coming out of it is extremely bullish. Yeah. Now you're looking at a nation which majority parts they don't have running water or electricity, but from a state of affairs point of view, it's moving extremely fast. You've got more and more citizens with access to the internet, thus online trading. You've got a humongous movement on gold, online gold buyers within India, which I think is going to be a huge movement within the next couple of years. So also that is on our minds. And of course, it would create a very big impact regarding these very bullish states that are coming, let's say, from statements that are coming from India at this particular moment in time. We've got so many fundamental factors out there that, you know, it's a collage of it that we have to read within. But on the other hand, given the stunning Indian and geopolitical drivers right now in play in Iraq, Syria, Ukraine, I believe that these price drivers are bigger than quantitative easing ever could be and ever was. It's a very high probability that gold could charge beyond the 1300 where we dropped from, 1320, 40s, 90s, etc. But again, there's always two sides to every story. That's why we're going to take time and look at the charts a little bit. We're going to start with a macro view on gold. So let's just look at what they say. Okay. Now, looking at our technicals, I would actually prefer starting with a macro view of our asset, gold. Beautiful. Look at this. You remember those days? You remember the 1900 days? That's beautiful. Put it this way, it took us about 6 years for this move to happen, okay? And it took us about 3 years for this 50% retracement roughly to happen. Yeah, we're looking at roughly, I could pull them from 05 if you wish, so we could be talking about 9 years. But I'm looking here, yeah, around the 2007, 2008 area. If we pull from this retracement to it, and if we pull to be looking at the longer trade, on the longer term ratio on gold, and again in a macro view of gold, we're looking at a 6 years move for the price to rally and spike to the 1916 levels. I used to love them, made a lot of cash on that. And of course, we're looking at a roughly 3 years retracements on the 50%, which would be actually encountered right here at this double bottom. This double bottom right here, where we're looking at, let's just see it for 1 second. Yeah, first one's been created roughly in June of 2013, and then you're looking at again in pretty much December of 2013. Beautiful double bottom. So I believe that we could be looking at pretty much higher level of support, this particular range at the 1180s, where we couldn't pretty much breach of, and as a move towards higher demand levels, of course. So macroeconomically speaking, if we're looking at a macro view of gold, once again, we're looking at a 6-year move in order for it to be able to spike and rally to the 1900s. And then it took us about 3 years for us to come back, retrace to the 50%, and create a double bottom around the 1180. Remember that number, 1180, double bottom, very, very important. Let's just look at our daily chart as well, because that's what would be a very interesting scenario that we're looking upon, of course, simply because as we analyze these particular trades, as we analyze these particular charts in the past couple of weeks, we did have, once again, as I said in the beginning of our chat, we did have a bearish gold with a bullish tone to it, correct? Let's not forget, indeed, we actually breached 1292. Yeah, we breached 1292. We also breached the 1280 on Thursday's trading. Okay, very, very important. I'm not going to explain where the supply and demand levels are in this particular video. I'm simply going to place them onto my charts, and we will talk about that at some point in the future. But as a good point in order for you to pretty much see them, let me put my colors in here. There you go. It's a very, very heavy supply level. Yeah. Okay. Very, very heavy demand level, which has not been broken yet. Yeah. And we clearly see the market from here. Rally, base rally, level tested, spiked and gave us roughly 800 pips, spiked to the demand level above, and of course it created demand. Very high probability for the 1261 to be hit, but regardless, we're looking at this particular retracement, and I'm going to make a combo of these particular two retracements. I've got one retracement here, so we can clearly see a very beautiful 61.8. Roughly here, a 76% FIBO right there. That would be our 76% FIBO. Yeah. Let's just put the 76% in as well so we can have it. FIBO levels. All right, let's just add one more. All right. Okay. There we go. Okay, so that's my 76% FIBO. Again, we're not forgetting the double bottom at 1180. That has been, yeah, double bottom. Beautiful, beautiful double bottom. Let's not forget our most important double bottom at 1180. That was pretty much our trend changer according to many. Yeah. On the other hand, a lot of the past couple of months, a lot of world economists, very, very big world economists, bank economists, changed their tune from a bearish gold to a bullish gold. You can actually follow that up as well. Very, very important thing to take into consideration. So what did we do? Once again, as I was saying, we already breached the 1292. We also breached the 1280 as well. So the next level, considering, would be around the 1265 area, yeah, on the 76.3 FIBO, or the 1261 area, looking at our supply and demand strategy again. But then again, we ask ourselves, aren't people, you would be looking at RSI and CCI as well, you could be looking at those levels as well, and once again, as the beginning of the video, aren't people much more bearish? When are the most bearish? They are the most bearish at the bottom of the trend. So very, very important FIBO retracements. And also, one more thing to take into consideration, ever since here, where our second double bottom, where our second bottom of the double bottom has been actually achieved, we're pulling it Let's just change the color so we can actually differentiate the two. Let's make these ones blue. Yeah. Navy. All right. Now what do we see? You heard me talk about the harmony in FIBO retracements. You're looking at the retracement of this daily movement, yeah, 76.3. You're looking also at a 61.8, as you've heard me talk in the beginning of the video, a 61.8 retracement, yeah. This was a 76.3 retracement on this move and almost a 61.8 retracement on the big $200 spike in the beginning of the year that we witnessed. So very, very importantly, very, very heavy level to be witnessed here. Obviously, two scenarios. In the end of the day, the next level, as I said, is at 1265 to 1261. If this level gives us a very, very strong support, or if it does not allow us to break through it, obviously we're going to be continuing to be looking at gold exactly with the same eyes that we were 2 weeks ago. On the other hand, it all depends, of course, on the fundamental events and the level of novelty of your traders, which is going to happen next month. I am pretty confident that this demand level should be touched once again, but indeed, but then again, you never know. There's always two sides to the story. The only thing that the chart is telling me right now is that I'm looking once again at a concerned bearish gold. And remember, the 1200 mark, it's even a, let's say, a word that big economists use. It's called the 1200 floor. Why is it called the 1200 floor? Well, it's only a matter of time until we're going to find out, and I believe that next week we may, or actually we may be looking in September. It's a very, very important month for gold as well. One more thing before I close this, and for you guys to take into consideration, we looked at our Fibonacci ratios on a daily, on these two particular Fibonacci ratios. Let me just differentiate them again. All right, there we go. So we did look at our Fibonacci ratios. We do see a harmony of FIBO retracements of 61 and 76% right here, encountering big support. But the most important thing for us to also take into consideration upon our planning our trade and of course trading our plan is simply that ever since the 1180 has been created, we encountered higher lows. Let's just look on a weekly. Double bottom, higher low, 1180. Looking at the 1240, higher low. Looking at the 1280, higher low. Now the only thing that we saw is that we looked at this particular, if I'm looking on a daily, I have as follows. Higher low, higher low, higher low, daily speaking, yeah? And then again, we have this major move as a breakout below the 1280. But once again, it's all about the level of novelty of your common trader. Very, very important levels. We are witnessing higher lows, but as many analysts may say, is that in order for us to actually have a trend correction, we also need to encounter higher highs. But in this particular circumstance, all we have is higher lows, and then again we have lower highs with a difficulty to touch here. Keep this zone in your minds. Very, very important zone here, yeah, at 1300 to 1310. I don't believe that it would encounter a lot of resistance from our particular asset in this moment in time or in the future when we'll get hit. But again, conclusion is yes, beautiful higher lows. No, not that beautiful lower highs. So in the end of the day, it's all about fundamentals, how fundamentals will impact the market in the near future. Once again, September is a very, very, very important month for gold, considering supply and demand imbalances. So that's it, ladies and gents, fellow traders. That concludes our view on gold discussion. Fundamentally speaking, we're looking at a concerned bearish gold with a bullish tone to it. Yeah, technically speaking, we did look at our higher lows, but we did see our lower highs as well. We looked at our FIBO retracements. We looked at our harmony between the two different FIBO retracements as well. we shall see what the next week will bring. September is a very, very big month for gold. If you did like this video, share it with your friends. Do subscribe to our YouTube channel and follow us in the future for much more.